Hello and thank you for tuning into this presentation on buying an independent insurance agency. We've broken it into three parts. This is part one, in which I'm going to discuss an introduction to the agency merger and acquisition market, highlighting some key information that you should know as a buyer. In part two, I discuss what's an agency worth, quote unquote, with a focus on some analytical tools that you can use. And in part three, I discuss the actual acquisition process and what you should expect, with some tips on how to navigate to a successful transaction. So each one is about 15 slides, should be about 20 minutes or so. I encourage you to watch all three if this is a topic that is of interest to you. Down at the bottom there, my name is Michael Mensch, Certified Business Intermediary, Certified Merger and Acquisition Master Intermediary. I'm also a Managing Partner at Agency Brokerage Consultants. Personally, I've been involved in valuing over 100 independent agencies and over 150 negotiations with buyers that were either licensed agents, private agency owners, private equity-backed groups, and then some regional and national brokerages. I hope you find this information useful in your ventures. Thank you. There's a little information about our company. We are a merger and acquisition advisory firm focused exclusively on the insurance brokerage industry. Our clients are in the P&C and life and health business. They're also retail or wholesale, so we kind of cross all ranges. We have three services that we provide basically. First one being valuations of independent agencies. We probably do 3 of those a month across the country. The second is we represent owners in the sale of their insurance agencies, so we help them prepare and market the business for sale and negotiate and get the transaction completed. And the third is we represent select number of buyers on a retained basis to go out and find agencies to acquire. This is generally buyers that have lots of financial resources, very experienced, looking for multiple acquisitions. But those are the 3 different services that we provide. I may be biased, but I believe our firm has more professional credentials than any other in the industry. All of our intermediaries are certified business intermediaries through the International Business Brokers Association. And all of our principals are also certified merger and acquisition master intermediaries, of which there's probably 150 in North America. Our team also includes certified valuation analysts, certified appraisers, and we carry any required licensings that is necessary to transact the sale of a business in the United States. So each state has different licensing rules on who can be involved in negotiating the sale of a business, and so we also are licensed accordingly. So the first question is, why would you want to invest in acquiring another insurance brokerage? Number one, if you own an agency already, it's an investment that you likely understand. So it's something that you have a pretty good grasp on how it operates, what the risks are. Number two, you can obtain a 25% or better annual return on your capital. So in most cases, you will be able to borrow money against your agency or the one you're buying, and through that leverage your money and get a good return on your money. Number three, it can increase your cash flow both through the acquisition itself and through other synergies, meaning revenue and expense synergies that you gain. And number four, it can increase the equity in your business non-linearly. What I mean by that is value of your business plus the value of the business you're acquiring would equal X. Well, most likely when you merge them, you're a bigger organization and you're going to have better cash flow, so the value is actually going to be larger than X. So it's a nonlinear increase in equity of your agency. Let's take a simple scenario here. Agency 1 has $1 million in revenue. I've broken up the expenses into some simple categories. $1 million in revenue, $275 in adjusted EBITDA. Agency 1's looking at purchasing Agency 2, which has $500,000 in revenue and $132,000 adjusted EBITDA. And so if you take those on the surface and combine them, you see what the revenue and expenses look like on a combined basis. But in reality, the end expenses would likely be less than what they are on the surface. Once you merge the two companies together, you're going to gain certain synergies. You only need one insurance policy. You only need one CPA, one phone system, and you probably reduce some of the employee labor force because you're going to get more productivity out of everyone. So there's usually some synergies that come that yield a reduction in expenses. So on the bottom we see some transaction terms. So let's say agency 2 was willing to sell at about $800,000. So how does this work for the buyer, agency number 1? So basically, you could expect maybe they would need a 20% down payment. They could borrow the rest. So I've worked out some numbers here. So with a down payment of $160,000 plus some additional costs for the acquisition, the agency 1 is going to borrow $680,000. Let's say they did it over a 5-year term at 7% interest. Then we look at that would create a loan payment on the right-hand side there of $161,000. So the new cash flow after paying off the loans is an additional amount of about $51,000 a year. So through this acquisition and after financing 80% of it, the purchaser is getting an additional cash flow of about $51,000 a year, which equals 32% return on their down payment. So you're getting a good return on your money. You're getting an increase in value because now you've got an organization that has $1.5 million in revenue and an adjusted EBIT of say $487,000. So the value is going to be significantly increased. Probably by doing this acquisition, the owner would almost instantaneously increase the equity by $200,000 or $300,000 in addition to what A plus B were equal to originally. So increased cash flow, good return on the down payment, and increase in equity. So this was exactly what we're talking about. So this was just a simple illustration to kind of show you how it works. All right, so next question is, where do you find opportunities? Well, there's generally a couple places you can go online. There's different websites that are out there. The reality is online you're competing against hundreds of people that are looking online. You may start to, if you've been searching a while, you contact some of the ads and maybe you don't get a response, maybe you get a slow response. But generally, you're going to have to look at a lot of opportunities. That means not just look at them online, but you're going to have to contact who's ever representing the seller, get information. Most likely, you're going to have to go through that process of getting disclosed, submitting information for them. You know, it could be 10, 20 times before you even really get a chance at putting in an offer because there's so many professional buyers that are out there that are buying up most of the agencies that they're on top of this all the time. So looking online is a good place to look at, see what's happening, but the probability of you being the person that ends up buying that agency is probably pretty slim. You can go around talking to people, talking to other agents, talking to marketing reps. That's generally a slow process. You could be looking at 2 years plus. You know, if you start talking to agency owners, you never know when they're going to sell. I mean, it could be tomorrow, but usually it's further down the road. You could do your own prospecting, make phone calls to agencies. We do this all the time, so I'm going to just tell you plan to make hundreds, if not 1,000 phone calls before you get some serious interested owners. And so it's a significant time investment. Or you can contact M&A and broker intermediaries. They generally will have some agencies for sale. Usually in our case, if you contact them, our clients' agencies generally go under purchase contract in a short period of time, so we don't keep an active inventory per se. You can get added to their buyer contact list. So, for example, with us, we send out a blind summary when we put an agency on the market, so you would be in the first round of getting contacted. Or you can hire the M&A firm to prospect on your behalf, and that's something that we do, and I can talk about a little bit more. But that's generally the options that you have. Go online, do some research, talk to people that you know, do your own prospecting, or hire somebody and outsource the prospecting. Let's talk briefly about the difference between a solicited and unsolicited opportunity. What I mean is an agency that is actively for sale versus one that is not actively for sale. Let's just, again, get some general conversation going. So one that's actively for sale, that you can find it online or you get information from an intermediary. Obviously, the pros are it's easy to find. The information has been put together, hopefully. So if you're looking at the agency and it's through an intermediary, they should have put together a booklet of information on that agency that should cover the history, the operations, the bit about the employees, how they do the marketing. Should give you a couple years worth of financial data, breakdown of the products, things like that. So there should be a good set of information prepared. Generally, the expectations are set. If the agency is actively for sale and through an intermediary, there's already been price expectations that are set. Generally, the owner is committed to the process. They've gone forward. They've signed an engagement with somebody to help them sell it. So they're committed to the process. The con side, there's going to be high buyer competition. We'll talk about that more. It's going to go quickly to an experienced buyer, so people that are out there buying agencies on a regular basis. There's companies, there's individuals that are probably, 20-30% of the buyers are purchasing 70-80% of the agencies. There might be less flexibility in the terms and price. Seller's going to want a relatively quick closing. Once they're committed to the process, they want to move forward. On the bottom side, which ones are not actively for sale? They're going to be harder to find. Obviously, they're not on the market. The owner's not going to be prepared for the process, so they're not going to have data ready. They're not going to have thought it through all the different details that go along with that. There's not going to be a known expectation of what they expect on price and down payment and things like that. And they may not be committed to the process. If they're not actively for sale and you're soliciting to them, it's probably not something that they've been thinking of. So they may or may not be committed to the process. On the pros side, if you're the only one talking to them, then there's not much competition. So it gives you also have a little more time to speak to the owner and work through some details. And you may get lucky and maybe the owner doesn't know what the industry normal is or what the market rate for an insurance agency is. Generally, that's not true. Usually the expectations are higher, but maybe they don't know what to expect on a price and terms and things like that. So you get a little bit of a better deal than you might otherwise. So that's basically just breaking it down, active versus non-active for sale. Generally, though, sellers have two main concerns when dealing directly with buyers. Number one is that the buyer is going to breach confidentiality, and two, that the buyer does not have the ability to get the deal done. So if you're contacting an agency owner, that's number one, and number two of their concern about you particularly is that you're going to breach confidentiality and talk to their employees, talk to their marketing reps behind their back, let other people know. And you don't have the ability to get done. You don't have the money. You don't have the knowledge. You don't have the experience in that marketplace with the same carriers, that sort of thing. Those are the obstacles that buyers generally face. And for good reason, too, because most of the buyers that are out there reaching out to agency owners, a lot of them do breach confidentiality, and a lot of them don't have the ability to get the deal done. So, but those are the obstacles that you face. Let's talk about the competition. There's a lot of it. So you have licensed agents that maybe want to own an agency. You have local competing agencies. You have investment groups, private equity-backed groups. You have regional brokerages. You have national brokerages. Generally, as you go up the scale, so goes the price competition. So national brokerages, Brown & Brown just announced the acquisition of Beecher Carlson at 3 times revenue or 10 times EBITDA. That's a pretty strong price that most people can't afford to pay those kind of multiples. So generally the price competition goes up along that scale. But the bottom line is there are hundreds, if not thousands, of potential acquirers in the United States for buying an independent agency, which makes it very difficult for the average buyer to go out and find and lock down an agency to purchase. So how do you increase your chances? Well, here's a couple ways for you. Number one is target smaller agencies. So the larger buyers we just talked about are generally targeting mid to large agencies and maybe a couple million in revenue and up. So if you are an independent private individual looking to buy agencies, you're most likely going to have a better chance of buying an agency that has less than $1 million in revenue. So number two there, widen your search criteria. Generally, only a few percentage of agency owners would consider selling at any given time. That's pretty much what we found to be true. So what we say is before we take on a buyer client to do a search for them, is that you need to be able to go to a wider geographic market area or hit a highly populated area, because you need to have a pretty sizable target demographic that you're trying to buy an agency in. So number 2 is widen your search criteria. Don't be just talking about looking for an agency in one small town. You really, if you're serious about it, you're going to have to expand out your geographic range. Number 3, know how much you can afford. That's basically the topic of part 2 in this series. But we all have big dreams, but typically reality wins out. So you got to understand what you can afford and where you can get money. Number 4, understand the process. That's a topic of part number 3 of this presentation. And the number 1 reason why 20-30% of buyers make 70-80% of the acquisitions, because they know the process, they move forward quickly, they know how to get the money, and they know how to make a deal happen. So one of the main reasons why for creating this was to educate the other buyers in the market of the things that they need to understand, that the ones that are doing all the deals have already worked through that process and learned. Number 5, be flexible when structuring a deal. So understand, we're going to talk about that later in part number 3 as well, but you got to understand the owner's motivations and be a little bit flexible to try and work the deal out so it's a win-win for everybody. 6, move diligently on opportunities. And 7, hire a professional to search for you. So if you don't have the time to put a lot of energy into searching, but you're serious about buying an agency, then you need to outsource that responsibility, because it takes a lot of time. And most of the professional buyers that are out there either have their own acquisition teams, or they dedicate a significant amount of their own personal time to finding agencies or reviewing opportunities that come up. All right, so some things that you need to understand about the marketplace. Number 1, you will most likely need 20-30% of the purchase price in cash. So I understand that there are lenders that tell you need less than that amount to do an acquisition, and that may be the case, but most likely for your first acquisition in particular, you're going to need at least 20% of the purchase price in available capital to make the deal work. Bullet point 2, you need to understand you're most likely going to have to pay a market multiple. What does market mean? Well, we're going to cover some of that in part 2, but I'm talking about what is a competitive price and terms on the down payment and that sort of thing. This changes over time based on the demand, economic conditions, the financing market, but you need to understand market multiple. So what other buyers are willing to come in and pay for that agency? Because if you're not willing to come in and make a deal work, the market rate may be X times EBITDA, X times revenue with 70-80% down. And if you're not willing to be competitive in that, then most likely the seller can find somebody else that will be. So bullet 3, I'm saying expect to deliver 70% or more of the purchase price to the seller at closing. It's long gone the days when you can do 30, 40, 50% down on an acquisition. That probably makes up a small percentage of the transactions that actually happen in the marketplace, and probably 0% of anything of substantial size. And the last bullet there, you need to be able to demonstrate the knowledge of the process. So the smartest and most successful buyers are the ones that can go in and talk to the seller about what their process is going to be going forward. Because if they've done multiple acquisitions, then here's what's going to happen, Mr. Owner. We're going to go through this. Here's what I'd like. And they sit down and educate the seller from their point of view. So you need to demonstrate the knowledge of the whole process. Number 2 there, the seller will most likely, point number 1, not care about your successes or that of your company. I say this with sincerity. The owner doesn't really care about what you've accomplished. You want to do a good job of selling yourself, but at the same time, don't expect them to lay down the keys simply because you're Bob Jones and you've done X, Y, and Z, and people know who you are. At the end of the day, they're looking out for their own interests, obviously. They're wanting certain expectations of how much money they want to get for the business and those things. So the number of buyers that go to these meetings and expect to have an influence on the seller simply by who they are is surprising sometimes. Bullet 2, expect the owner to move at their own speed. With the old saying of hurry up and wait. So people want to hurry up, and then sometimes we're waiting for things. So they're going to move at their own speed. It's okay. That's just how things work. They have their own other things going on. At bullet point number 3, understand that the seller not going to have empathy for you if you can't close the deal. If you can't get the financing and you come back and try to renegotiate, they're not going to have any sympathy, any empathy for you. It's just the way it is. So just some reality expectations here for you. All right, so this was just the introduction. Hopefully there was some good information here. Part number 2, we're going to have a separate presentation in which we talk about ways to analyze the purchase as an investment and go through understanding transaction terms. And part 3 is really about the acquisition process. I've got a little schematic there, but we go through that in detail, each phase of the process, so you understand what to expect, what questions you should be asking through that process. So here's an overview of the value that we bring to the process for buyers. So I'm going to obviously do a little bit of a sales pitch here, but so our advisory value that we bring to buyers is, number 1, we originate opportunities. We are known in the marketplace. We are active in the marketplace of talking to agency owners, so we can originate opportunities for buyers, both in a capacity of working for them and in the capacity of working for the seller. We facilitate discussions between the parties. We know the expectations, what they should be. We talk reality to both parties. We perform a pre-due diligence. Understand, especially if it's our client that we are representing the seller, we've already got the tax returns. We've already got we performed our own pre-due diligence. So what the information you receive from us is probably 95% plus accurate. So there's not a lot of discovery that you need to do. We do our own pre-due diligence. And if we're working for the buyer, we go through the process of trying to do a pre-due diligence before releasing the information. We assist with drafting and negotiating offers. We assist with organizing the due diligence. We put a lot of effort into organizing the due diligence. We assist with the financing. We probably have more experience than anybody in the country with getting small agencies financed, up to a couple $1 million in financing. I would say we probably have more contacts than anybody else in the industry. We help reduce the stress of all the parties involved. So we're an intermediary. We're in between the parties, trying to keep the deal together, assuming it's in our client's best interest. Our job is to keep the deal together, keep everybody calm and focused on the task at hand. And of course, the last part, we make a deal happen. Knock on wood, we've have very strong track record of seeing things through, again, assuming it's in everybody's best interest to do that. So I like to say we are exceptionally good at what we do and work exceptionally hard for our clients. But don't take my word for that. Here's some quotes from some of the clients we worked with. The first one was a buyer that purchased one of our clients' agencies. The second quote is for an owner that sold to one of our buyer clients. I worked with him directly. He was happy with everything. And the last one is from a senior loan officer, actually from Oak Street Funding, who's probably reviewed more agency acquisition loans than almost anybody in the country. So I'll give you a second to read those over. And here's a sampling of what we call tombstones. These are completed transactions. These were all working for the buyer. Just like the quotes on the previous page, just a sampling. We've done a lot more than just these, but you'll notice they're spread across different states, different size buyer clients that we worked with. And so you'll see that we are active in the marketplace. So this concludes part 1. I thank you for your time. Hopefully this information was useful. Don't miss parts 2 and 3 of this series and our other online presentations that are viewable on our website. If you would like copies of these slides or have any questions, please feel free to contact me. There's my email and office number. I thank you and wish you all the best of luck.